And we are live. Welcome back, everybody. I am Kai, and we are doing my weekly live stream where I interact with you guys. You guys can ask me questions, and we're going over a couple of market updates that have been happening this past week as of today, which is June 7th, 2020. Now, the market is opening back up, or not the market, but the economy, and there have been a lot of changes, good and bad. So today we're going to do, like I said, we're going to do a quick market update, and then also we're going to talk about how I might have been really wrong about the market. Okay, we'll dig into that. We'll dig into that a little bit more, and then we're talking about changing tactics in real estate, both short-term and long-term, and then towards the end, we're going to value Marriott Hotels, which I think might be a pretty big boon if you invest either now or maybe later this year. We'll see. But before we jump into that, I want to make sure that this is up and running. So I'm going to send this out. Can you all hear me and see me? As always, got to make sure that the tech is working just right. So you got this right screen up. Fantastic. Hey, Jen. Jen jumping right in. All right. So that's working. Fantastic. All right. So as people are trickling in, feel free to jump in the chat, ask questions. If I say something incorrectly, or even if you have questions about it, throw it in the chat. I'm going to look over. The chat screen's over here, camera's here, and then my notes and my spreadsheets are on this screen. So if I don't look over, I don't see it right away, I'll look over and I'll get to you as soon as I can, okay? So quick update. I am going to try to keep today's live stream to an hour. I know the last couple of weeks, I think this is our 5th or 6th week in a row, which is pretty good for us. Is that they've been going like 2.5, 3 hours. And today I've actually got to work. As you guys know, I am remodeling and residing the house, and I'm out there working, and I'm on this time crunch because I rented a big machine. It's called a boom lift. It's a 45-foot boom lift, and it costs me about $200-$300 a day when I'm not using it. And so I'm expecting to use it for about 30 days. I don't want to hold on to it any longer because it just drains the bank account really fast. So anyways, I want to get back out there working because we got a bunch of rain coming in this week, and I basically have no siding on half my house. So I want to make sure I get that taken care of, and I'm in like construction mode, but I also obviously want to interact with everybody here and make sure I get my YouTube videos out, because if you guys haven't noticed, I haven't posted a YouTube video in 2 weeks. My live streams are the only thing that I have going on. It's just so crazy right now. So anyways, if you guys have noticed, the May numbers just came out, actually a little bit better than expected. Let me see. Unemployment rates dropped down to 13% from nearly 20% in May. Now, you guys remember back in May, the beginning of May, a lot of states were starting to slowly reopen, and then by now, all states are basically open with obviously restrictions, different phases, and they're trying to push back the infection rate of COVID-19. And they're doing it pretty well. I mean, there's some small spikes here and there, but overall, as the entire for the entire month of May, we really didn't see a huge spike up in terms of overall infection rates or what do you call it? Death rates. Okay. Now it's still there. If you look at the graph, it's trading kind of sideways. There's these dips and spikes, dips, spikes. Kind of looks like a stock market, but overall, it's been really steady for the last 30 days, which is pretty encouraging. And then as the economy starts opening up, we saw, I believe the rough number is 6 million jobs added in less than 30 days. So in 4 weeks, 6 million people went off of unemployment. Now, this was to be expected, right? So we had 42 million unemployed at the peak, or furloughed. And then right away, when the economy started opening up, 6 million went back to work. So there's still, what is that? That's still 36 million people unemployed. Now, half of those, so let's say 3 million of those, were in the tourist and the traveling industries, okay, or hospitality industries. So think about hotels like Marriott. That's why I want to talk about them later on in this video. So really interesting to see But we got to remember that still there's over 30 million people currently unemployed with the economy starting to open back up. I personally think that that number will slowly get down to 20 to possibly in the teens, so maybe 15 to 20 million, which keep in mind at the peak of 2008, 2009 Great Recession, that number peaked out at about 10 million unemployed people. So we're still way above that, even if we get it down to 15 million, which is 25 million, over 25 million Americans getting their jobs back, okay? So we're still in a rough spot there. But why does the stock market keep going up? And we're going to get into that and how I possibly may have been very, very wrong, which isn't the first time. But I also may be right. But we'll talk about that a little bit. So there's been a huge surge in the stock market. If you guys haven't noticed, the last 2 weeks, the market has been rallying harder than ever before because it's been gaining 2 to 3% a day. To give you an idea of that, current money market accounts, current good rates in the bonds, yields, and CDs is 2 to 3% a year. And the stock market has been giving you 2 to 3% a day, okay? Right now, Apple has reached brand new highs, record highs, higher than pre-COVID, and they just hit, I believe it was 1 trillion last year, 2019, and they are now past $1.5 trillion market cap or valuation of the company. So basically all that means if you took all the stocks in Apple and you multiplied it by their current share price, which is like $300 and something, it's over $1.5 trillion, which is mind-blowing. Thinking about how long it took them to go from zero, which basically back in the 80s, 90s, to get to 1 trillion, was that 20 something years, 30 something years? And then they do 1.5 trillion in a year, give or take. It's pretty insane, and it has a lot to do with this market and what's going on. And I'm going to tell you why exactly that's happening right now in the middle of one of the worst recessions for sure. Now it's kind of like we're teetering on, is it a recession or is it depression? One of the worst recessions, why there's these companies that are peaking out, like right, Facebook, Google, Apple, Microsoft, there's one other, Amazon, Tesla, Chipotle. All these companies are peaking out pre-COVID levels. We'll get into that. And as of today, like I said earlier, all 50 states are basically back and open with an asterisk, right? Most states I know are in phase 2, which is open but with restrictions. So like gyms and studios, dance studios, restaurants, there's this social distancing, masks, gloves, sanitization, all this stuff that's going on, which is going to be interesting to see how it plays out because right now the current expectation is that perhaps up to 1 million businesses in the United States in the next year will be going out of business. And that's rough. That's really, really rough. Even if it was half that, 500,000 small businesses, restaurants, mom and pop stores, that's really, really tough and challenging. Now, a lot of the bailouts are meant to keep or help out those mom and pop stores, but I think that there's something wrong with bailouts. And it's what's leading into this faux rally in the market. And the reason behind that is when you do a bailout, and I don't want to say this, I want to make sure that I'm saying this, that I'm not trying to be callous or mean or anything. This is purely an objective, no emotional way of looking at it. Obviously, my feelings and emotions, they have different stance, but this is how it's supposed to work. So there are corrections in the market and there's corrections in everything, right? But if you look at business and you look at the market, there's these corrections, these recessions. And when these recessions hit, what it's meant to do is to cull out, get rid of businesses that are not sound, that might have just been starting up, but it's not the right time. They might have gotten even, for a lot of folks, unlucky. But for the vast majority, it's to cull out or get rid of the companies that were not sound with business fundamentals. They didn't save enough. They weren't making enough. They're just kind of latching on, living off of debt or living off of just like hopes and dreams, right? And what you do is you wipe out those businesses, small, medium, and big. Big corporations, small mom and pop stores. And what it allows to do is it gets rid of like that bottom 10 to 15%. Right? In the market. And then that allows other entrepreneurs like us, right? If you wanted to open up a Korean restaurant, you want to open up a car wash, or you wanted to open up some sort of new tech app that allows people to connect somehow. It allows new entrepreneurs to enter the field with better business practices, right? Solvency and liquidity. Remember those two things? Basically, how much cash you have and how much cash flow you can create. And it, over the long run, it elevates the market and makes the whole community better. Now, what happens with these stimulus packages is not only does it infuse a bunch of money into the system and makes everything look good, right? Which is good for most people and everybody with retirement accounts right now who are freaking out 3 months ago and now they're all happy, is that you keep those 10 to 15% of businesses who shouldn't still be in business because of bad practices, bad leadership, bad management, or just unlucky. You keep them in business. And in the long run, it I don't want to say poison. Poison is too harsh of a word, but it weakens the overall market. And you do this several times over, you can see how that compounds. So in 2008, 2009, the government kept a lot of banks and a lot of car manufacturers in business. And that's arguably like, what if we had, I would make the argument, it's like, what if by now we could have had 3 more or 4 more Tesla type of companies that are reshaping the world and pushing us more towards a better travel economy, right? Transportation economy, than having Chrysler, GM, and Ford still in business, which, stocks haven't really been doing great, where Tesla has like 20x in the last 10 years. So that's the problem with stimulus. There's also good stuff. It saves a lot of jobs. It saves businesses, of course. But right now, we're seeing this big bailout, and I think the number right now is around $3.5 to $4 trillion that has gone into the economy. Trillion with a T. Insane has gone into the economy, and they're waiting to push that button to print more money to bail out the economy if a second wave happens in the next couple months. 4 months in fall is usually, right, when the flu season starts picking up again. So we'll see. But all right, so that's a quick update. Let's jump over here. What's up, Manuel? Josh? Crispin? Thanks, man. You like the shirt? This is Goodwill. I got it. It was like brand new at Goodwill. What's up, Cedric? Yeah, I'm excited that you're excited. I'm excited too. Pretty sure that the market is in a bull trap. It might be. And what it is it causes a bubble. But we'll talk more about that. I might have been wrong, and I want to dig into why I may have been wrong. What's up, Juggernaut? Nicola, somebody else, did you message me about that? Somebody else, I didn't get to, again, I apologize. If you guys are commenting or sending me DMs on Instagram and I'm not responding, I am super sorry. I try to get back to everyone I can, but sometimes I'm 35 feet up in the air with both hands like dirty and I can't text and I forget about it. So somebody else asked about Nicola. I'll talk about that. Let me write that down. I'm going to write these out. Keep asking your questions and we'll get to it. But I have thoughts about that. Nicola. Okay. What's up, Ethan Evans? Yo. All right, I'm just taking notes here. Let's see how many people we got in here. We got 13 people. Fantastic. Welcome, y'all. All right, so the first thing, let's talk about why I was wrong about the market. So we talked a little bit about if we go back 3, 4, 5 weeks, we talk about what I've been seeing in the market. I was like, the dip is coming. And I'll put a caveat to this. I still stand by that. I believe in July and October, that's going to be the true stress test for the market and what we see. So I'm not bailing out or doing anything drastic. But I could be wrong about the market because of a couple of key factors, right? We talked a little bit about the stimulus programs, right? The $3.5, $4 trillion that the government is printing and bringing into the economy. I've talked about how that deflates or devalues the US dollar. And right now we don't see inflation because nobody's spending it. We're actually seeing the highest amount of savings in the United States that we've ever seen. Again, correct me if I'm wrong, but the rough numbers is that typically the savings rate is roughly around 15-20% for the average American. We are seeing that nearly triple to 50 to 60%. Okay, so the average household is just holding on to cash right now. And so what that does is it doesn't create inflation, okay? It actually doesn't create, it creates actually something called deflation if it continues. Now, with that, remember the Federal Reserve, I told you they have two main buttons. They have two main superpowers. They have a lever to basically reduce, or I guess it's the dial, right? It's a dial that can increase or reduce interest rates. And then they have this button that they can push and print money. And it's really simple for them to do either. Now, we know they pushed the button to print money 3.5 trillion times already, right? Now, the knob or the dial, they've reduced the interest rates down to 0.25%. Now, this is important on a couple of factors, okay? And I got to get into this. I got to make sure I get my mind right because I got so many things I want to talk about and I don't want to just like purge all over you guys. But so that 0.25% is basically what the United States, our government, can borrow the money at, okay? Give or take a couple points. But it's right around 0.25%. So basically the government just borrowed $3+ trillion for 0.25%. Again, I've said this before, if you give me any amount of money at 0.25%, I'll ask you, how much can you give? Give me all the money that you possibly can if you give me an interest rate of 0.25%, because I can do anything and everything to make more than 0.25%, right? In the long run, anyways. So that's essentially what the government did. So it's not really a bad practice in theory with the government taking out $3 trillion at 0.25%. And remember, the overall interest rate on all the debt in the United States right now is right around 2.6%. Obviously it's not good to have $25 trillion in debt, but at 2.5% or 2.6%, and we know that our economy typically grows at 3%, it's not that bad, okay? Now, I don't agree with it, but it's not that bad. Now, a lot of things are something that a lot of people don't focus on is that we forget that the United States actually owns debt too, okay? We don't just have debt. We own debt. Now, out there, so like, for example, when we lend out money to help rebuild Japan, or we help rebuild the European Union, or countries in Asia or the Middle East, or whatever it may be, when we lend out money, we give out foreign aid. Foreign aid isn't necessarily just free money, food, clothes, that type of stuff, right? A lot of times that comes with a charge or debt. The United States owns roughly $22 to $25 trillion in US dollars in debt. So it's like you, for example, if you're at home, right? If you say that you own a house for like $250,000, you have a mortgage for $250,000. But at the same time, you have a bunch of other people who owe you $250,000. And if they're anywhere good at doing business or economists, they rented out that money, or they loaned out that money at a higher interest rate than they are paying. So if 2.6% is the interest rate that we're paying on our debt, we would be smart to assume, or maybe that's too hard of a word, but we would be wise to assume that the United States loaned out $25 trillion to the rest of the world in US dollars, and I'll explain why that's important here in a second, at a higher interest rate. Even at 3%, only at 0.5% higher, that's a lot of money when you're talking about $25 trillion. You're talking about hundreds of billions of dollars in interest. So maybe not hundreds, but definitely tens of billions of dollars in interest. All right. Now, the reason why it's important that it's in US dollars is that 70% of the global economy uses US dollars. And when you use US dollars, that means it's in demand. So printing $4 trillion, it sounds horrible. And it is. But it's not that bad because so much of the world wants US dollars, especially other countries. And that's why we didn't see a huge inflation. We actually didn't see any inflation in 2008, 2009. When we did print out, I forget the exact number, it was nowhere near as much money as we printed here, but I believe they printed around $2 trillion over the course of like 3 years, 2.5, 3 years, back in 2009. So it's because the U.S. economy, the world economy ate up all that money, All right. And that's what the government or what the Federal Reserve is banking on right now. And I can't fault them. It's true. Now, if you had done this with any other type of dollar, let's say the yen or the pounds or the euro or the Australian dollar or Canadian, let's say the Canadian dollar, you would have destroyed the Canadian dollar because the Canadian dollar is not wanted in Sweden or in Germany or in Japan or in China. Okay. Everybody, most people, 7 out of 10 people around the world wants to use US dollars. And this is all gearing towards why the market is going to continue to go up, is because even though we printed all this money, the world still wants US dollars, and the world still owes the US government, us, the taxpayers essentially, a lot of money. And what that does is it allows us to boost our market, and it boosts something that allows this bull market, and that's investor confidence. Okay, let me jump over here real quick. What's up, Mark? After a stock split, the share price devalues. When does it go back to? I'll answer your question here in a little bit. I'm going to put it right here. Mark's question about stock split. Okay. So why I was wrong about the market, going back to that, is that investor confidence boosts up the market. Okay. Now I disagree with it because we all know that I believe in value investing or the fundamentals of the business. I want you to show me that you can make money and that you have money in the bank account. I don't want you to show me that you have a ton of debt and that you were hoping on the number of eyeballs and that sometime down the road you can make money, maybe. I don't want to give you money for that possibility unless you show me a very clear path. Okay? That's me though. That's not for most, if not all, the other investors out there. And what they're doing is because investor confidence is up, right? And interest rates are low. And the reason why what happens to the stock market when interest rates are low is because people like us, okay, but think about people with tens of millions, hundreds of millions of dollars, right? And I'm talking about big funds, hedge funds, wealthy investors, the people that hold the vast majority of the investment dollars. They normally would invest and diversify into bonds, treasuries, maybe even some certificates of deposit, money market accounts, if the interest rates are like 3, 4, 5%, whatever it may be, right? But when those things drop down to nearly 0%, like bonds right now, where they're like under 1%. Savings accounts yields are around 1%, less than 1%. Some of them are at 0.1%. So what ends up happening is that money moves out of those markets, out of the treasury, out of the bonds, out of the bank accounts, out of the savings account, checking accounts. And the only other place for it to really go is two spots, real estate and the stock market. And right now, the stock market is always going to be more liquid. And a lot of it transfers over to the stock market. And so you're seeing this influx of money coming into the stock market because interest rates are low. And historically speaking, as long as interest rates are low, money will stay in the stock market. And so now those are two reasons. We've got investor confidence and we've got a ton of money transferring from other investments with very low returns into the stock market, okay? Those are two reasons why I could be wrong about why the stock market keeps going up. And then the number 3, I got 2 more. Number 3 is that the Federal Reserve is going to continue. They've already said this. They already announced it. It's 100% true. They're going to keep doing it. Is we will keep printing money as long as it takes for us to get out of this recession. And that's really, really scary for bearish people like me who wants to invest on the fundamentals of a company and understand like you invest in the value of a company, the intrinsic value of a company. When you have somebody saying like, hey, no matter how bad the economy is, no matter how little a company makes, the corporate earnings, all that stuff, it doesn't matter how much money people are making or how much companies are making. We will push this button as long as it takes to give people more money so that the market stays up. That's really, really scary, okay? Because that will eventually stop at some time. We don't know if it's 5 years from now, 10 years from now, 20 years from now, but it's not a good thing in the long run. And it's also scary in the short run because it creates where things should be a bear market, it shoots it up like what we see right now where we have companies hitting new peaks. So that's the third one. And then the last one is that right now, we guys got to remember the stock market, real estate markets, sort of, kind of, but mostly the stock market is always a bet on the future. Okay? It's never about the present, very rarely about the present, and never about the past. When we get our numbers, when we get like quarterly earnings reports, everything that I do on the valuations, that's on the past. And what it does is it gives value investors like us, right? And other investors, there's other types of investors too, but it gives us a way to project out the future, right? Even in value investing, what I'm doing is I'm looking at what they've done in the past and I'm seeing like, can they keep replicating this in the future? And let's look at their past trends and their follow through rate. And let's see how much I believe that they can do that. And then I apply a value to it. All right. Now, what's happening is that the vast majority of investors, because of like Robinhood, and I'm not saying it's a bad thing, it's a great tool. It's allowed a lot of people learning how to invest, to trade day to day. But what it does is it brings in a lot of voters, right? And that's all stock investors are. They're voters. You're voting with your dollars. Is it brings in a lot of people who don't understand the fundamentals or don't care about the fundamentals of business to invest in the stock market. And that pushes the market up. So because you have a lot of people getting hyped up on certain companies that make no money or who are trading at 120x to earnings. And they'll keep buying it, like Chipotle, which is trading, I believe, at like 85x, when their industry normally trades in the 30s or the 20s. So you have these crazy overvalued companies. And it's not because they're bad companies or they are really good companies, but it's because you have a lot of voters who don't care about the fundamentals. And so you group that all together. You got people who don't care about the fundamentals of business. You've got a large majority of investors. You've got the Federal Reserve printing money and saying, we will keep printing money. Don't worry. We're not going to go into recession. If we see a small dip, we'll print more money. Okay. And then you've got the demand for the dollar. And that you've got a lot of people wanting the US dollar. And then you've got interest rates being super low. All four of those are what's making me reconsider my stance. Even though I strongly disagree with them, right? Even though I disagree with them, I can admit that I may be wrong in the short term why there's a bull market and why everything is going up. Now, we will see truly in July. We know this, right? We know that in quarter two, most businesses, a lot of businesses, no, I shouldn't say most. I'd say a majority, okay? A vast majority, maybe 50, 60, 70% of businesses didn't just see a fall in earnings. They saw 0% revenues. When you do a stress test on a business, you stress test it on, I always do this, and we'll talk, if you guys are interested in it, we can talk more about running small businesses, opening small businesses, is that you do a stress test. You always do a worst case, a most likely case, and a best case scenario. And then you do everything in between if you want to. And the worst case scenario, I've never gone below maybe 50, 60% of revenues, right? Like something really bad happens and you get hit really hard and your revenues get cut in half. I've never done a worst case scenario where it goes to zero. Okay. And you can expect, if I'm not, who's very generally conservative, if I don't go down to zero, you can bet that most other people don't. And so those numbers are going to come out here in July and August when quarter two is going to be announced. And then you're going to see it again in October. And so when those numbers come out and we see these earnings statements that are way worse than the previous year, and we'll see how the market reacts to that. And if it reacts in the opposite, like it is right now, and the Federal Reserve just prints out more money, I could have been wrong about this whole thing. Okay, and that's what I'm. I shouldn't say I'm banking on it, but I am putting a lot of weight on July and August earnings and October, November earnings, and seeing how the market reacts to that. Because if it reacts fundamentally in the opposite direction, I might just say, hey, I'm going to stay clear of the market because I don't understand what's going on. If I don't understand what's going on, I always pull out and I kind of step back. And truthfully, that has prevented me from making a lot of money, but it's also prevented me from losing a lot of money too, because I don't like investing in something where I don't understand it. I don't understand how a company can come out and show negative earnings, but the stock price goes up. Doesn't make sense to me. So I'll step out. But I could have been wrong. All right, take a quick break and let's look at some of these questions. All right, so Mark. Well, actually, there was another question here about Nicola. Juggernaut asked. So people are thinking that Nicola, if you guys don't know this, Nicola is coming out. Juggernaut, remind me if I've got any of this correct. I just heard about this in passing. Nicola is a new car company, right? You guys know Nikola Tesla. He's like the grandfather of electricity. Read into that. I think there's a really cool podcast called Drunk History where they talk about Nikola Tesla and Edison and how Edison was actually a ripoff of Nikola Tesla. Yeah. But anyways, Nikola is another car company, and I believe, correct me if I'm wrong, they're running vehicles off of hydrogen. You guys remember that back like maybe 10, 15 years ago where we thought that hydrogen was going to become the new car or the new fuel for cars? Nikola is doing that, and they're competing directly with Tesla. And a lot of people are hyped up about it because I guess they've made a lot of forward movement in their vehicles and their technology. And the only thing with that, though, is you've got to remember how much Tesla struggled in the beginning years because we didn't have the charge stations. I was just looking at in my Tesla below in my garage. I was looking at all the supercharging stations in Canada and the United States, and it is littered across the country. You can literally drive almost anywhere in the country and have a charge station within range. And I remember so vividly because I wanted a Tesla for so long and for a long time, I didn't want a Tesla because I'm like, how do I charge it? Where do I go to charge it? And if you guys remember how hard that was, and that's with Elon Musk at the helm, who had hundreds of millions of his own dollars to put into the company and investor backing to do that. All right. And I would say Elon Musk is 100% a once in a lifetime or once in a generation entrepreneur type. I'd say even maybe multi-generational. Okay. But he's the one because like we've had the JP Morgans, we've had the Vanderbilts, we've had all these people who've made a lot of money in their respective area where it's steel, it's oil, it's banking. We've never had an entrepreneur who's done like space travel, transportation, energy, right? He's doing what JP Morgan did for the banking industry. He's doing what Vanderbilt did for the steel industry, or was he Vanderbilt was steel, right? Or was he railroad? Anyways, you guys get what I'm saying. Henry Ford, right? We think of Henry Ford as one of the great entrepreneurs. One guy is doing all of that. Banking, you can argue because he did start up PayPal, okay? So we have that type of entrepreneur in Tesla. And you got to look at Nicola and say, like, does Nicola have that? Does he have that type of money, first of all? Or do they have that type of money? Second of all, do they have that type of person in the back? And also, do they have the momentum to push that company forward? And I would say right now, again, this could be me being conservative, is that speculative, I can't even pronounce my words right now. As a speculation, I would say that Nicola will not be able to do that. And the reason behind that is because the world right now is pushing electricity. It's not pushing hydrogen. And if hydrogen were to come out, you've got to think how many hydrogen stations are there. Now, to be fair, I believe it was Walmart, a big trucking company, actually pre-purchased 30 or 40 of their trucks. And they're going to test it out. But I mean, it's easy if you're a giant billion-dollar company to have a couple of hydrogen tanks on site or at the warehouses to fill up your own cars or your own trucks versus you and I. It's like, okay, where do we go to fill up my hydrogen tank? And this isn't something that you can just attach to a grid like a supercharger, right? Supercharger, you just tap into the grid. A hydrogen gas station, you would actually need to create that whole infrastructure. So for Nikola, I would say pure speculation. If you're really into it, you can gamble on it, but I don't think that they are going to, they're not going to be able to push off electricity because we've got too many electric cars. The world is moving so far towards solar energy and electricity. And I'm not saying that hydrogen is bad. I think hydrogen may be even better. But I don't think that the world is ready to take a left turn and go towards hydrogen. All right. Mark asks, okay, Kai, after a stock split, the share price devalues. When does it go back to the original price after being devalued? I.e., 100 shares 2-to-1 split. Can you do analysis for ticker LIT? Mark, that's a good question. So how it works in a stock split and then LIT, I'm not even sure what LIT is, but I'll take a look at it. I won't do a full valuation, but I'll look at their financials. Is the best example I had for a stock split is, I think it was from my undergrad business professor. It's like, imagine I have this pencil here, right? This represents one share. And what I do in a stock split is I break it into two. I'm not going to actually break this. This is actually one of my favorite pencils to write with. But you guys get it. If I break into snap, I have two pieces, right? It's still one pencil, but now I've just split it into two, so I can give one to you, Mark, and I can give one to like Cedric, right? You guys both have half of the pencil, but it still equals the one share that I previously owned. Okay, so I get your $50 that you give me, Mark, and then Cedric gives me $50 for the other half. I have $100, but when you put the two pieces together at 100, or you put the two pieces together, it equals 100. Okay, that's the same thing with a stock split. So it doesn't mean that just because I break it into two, and it's currently worth $100, and I give you one and I give Cedric one, that it's going to eventually get to $100 again. Because then that means that this one pencil should be worth $200. You see what I'm saying? So for after a stock split, what they're trying to do in a stock split is to make it more affordable to bring in more investors. Okay. Now there's a couple of other reasons why they may do a stock split, but mostly it's because Let's go get crazy here. Let's talk about like Tesla. We know that Apple did this before too, right? But let's say Tesla's trading at, let's say, $1,000 a share right now. A lot of people can't afford $1,000 a share. So it keeps a lot of people out from investing in Tesla. Now let's say Tesla does like a 4-to-1 stock split. So they go, okay, let's break our stocks up so more people can buy it. And let's break it down to $250 a share. So they'll break it up into four, take one share, they break it up into four, so more people can buy it. Now, for that share, right, in your example, let's forget Tesla now. Let's go back to your example where it's a 2-to-1 stock split. For it to go basically double in price, the company has to double in value. Okay, so this original pencil that was normally $100, I would have to find some way as a company to increase it to $200. And then the stock split where you each have a $50 share or $50 half of the pencil would then go to $100. So it's no different. Even during just because a stock split happens, doesn't mean the prices will go up. If anything, you'll see a quick spike in price is because more people will buy into the stock. But again, it's all going to rely back on the fundamentals of a business, how well they run the business, and then how much investor confidence there is to invest in that company. Does that make sense? I hope I cleared that up. I might have butchered that example that my professor told me. Cedric, how do you feel about your? I'm gonna put LIT. Let me put light in here real quick, so I don't forget. Financials. How do you feel about your inverse S&P ETF? I am doing a similar thing and I'm going to stick with it. But as you know, even sideways moving markets are really bad for us. Do you think about selling? Cedric, I don't. And a lot of things that I recommend to you guys on this channel, I share it with you as an education, as an example. Use me as an example so that my mess ups, you can learn from it. My wins, you can learn from. Okay. Right now, I got a lot more mess ups than wins as of late since March. So I want you guys to remember that. If I show you guys my Robinhood that I'm kind of experimenting with and playing with, when I invest in the inverse, for you guys don't know what Cedric's talking about, is I invested in this 3x inverse S&P 500 ETF, which is basically whatever the S&P 500 does, it does the opposite, the inverse, times by 3. Okay, so whatever it does the inverse of it times 3. And what I'm betting on is that by 2022, the stock market will finally hit another crash or go into depression. And if that happens, my ETF is going to, or my inverse ETF is going to skyrocket, right? Now, in the short term, I keep buying into it whenever the market goes up, and I should be buying another one here shortly. And I'm buying it out in 2022, which basically means it gives me a year and a half, 18 months-ish to watch the market go down eventually, if it goes down. Now, remember when I do this, Cedric, I'm doing it as a pure gamble. This is such a small percentage of my portfolio that I'm not going to sell it unless something like crazy happens or something that really, like if they come out with a vaccine and that the world's economies all come together and we create like a union and everything is solved. There's no more trade war with China, and we fix Congress and fix the political system. There's no more racism in the U.S. or the world, and then I'll be bull and I'll change my stance. But we got to remember that right now we're still in the midst of a pandemic, right? We're not out of it yet. We still are in the midst of a trade war. We are in the midst of we're in election season, basically. We're about to step right into election season. So there's still a lot of stuff. And you guys got to remember, like, I know a lot of you folks out there are younger. Some of you are older. Some of you are my age. I remember 2007, 2008 very, very clearly. It took nearly 2 years, more than 2 years, for us to see the effects of the bad mortgage practices. I remember seeing the initial movement of because I literally just bought a house at that time, 2007. That's when I began seeing it. We all know it as the 2008, 2009 crash, right? It hit bottom in 2007. I saw it because I literally bought a house in June 2007. So right now, we are still at the beginning of it. And I am still believing that we will see a depression by 2022. And so therefore, answer your question, no, I'm not going to sell it. I'll probably hold on to it very close to the very end. These are option calls that I purchased, you guys that don't know what we're talking about. So I'll hold on to those. If I lose it, I lose it. I think I've invested just under $3,000 in it right now. I'm not going to sell it. And you shouldn't. I should be very careful how to say this. I'm not giving you stock advice. But with inverse ETFs, you should never buy and hold the stock. You should never buy shares. They're never meant to be held onto for more than a day. Me buying options is a little bit different, but still super risky. So I would not buy shares, individual shares of any type of inverse ETF. Okay. Hope that makes sense, Cedric. Okay, one more question. We'll jump back into it, and then I'll answer more questions as these come up. What's up, Steve? What's up, Oladokin? I'm sorry. I'm horrible at pronouncing stuff. Yeah, you're right. It is a truck company. They don't need Oladokin is talking about Nikola, and they're a trucking company, and they don't need hydrogen. You know, if they want to play in that field, and if they can outperform Tesla's electric trucks, and other companies are coming into the electric semi-trucks and flatbeds and such, if they're more efficient, they're more cost-effective, they have better maintenance records, they have better resale values, they're safer, right? You guys remember, hydrogen is highly explosive, right? If all of those, then yes, they could possibly overtake electric. But I just think it's the same thing as, like, why don't we run cars on kerosene? Or how come diesel hasn't taken, well, a lot of that has to do with like regulations. But why isn't there pre-electric cars, why isn't there several different types of fuels that we can burn running out there? And the reason behind it is because our grid system, the most effective way of doing a grid system is to have one primary, right? Like even with propane, right? Liquid propane. we have those, but we save those for like certain, like my the boom lift that I have right now runs off liquid propane. Forklifts run off of liquid propane. But in theory, you could have a car running off liquid propane, but we don't, because it's more effective and efficient to have a bunch of gas stations with, gasoline and diesel than it is to have liquid propane everywhere and running all cars off of liquid propane, or having half and half. And so that's why I think that Tesla has already entrenched itself, along with Ford, GM, BMW, Volkswagen. Everybody's coming out with electric vehicles. And it's going to be very, very difficult to shift the entire market just because you have a hydrogen truck. But if they want to focus on one area and just do trucks for like commercial, well, then possibly. I'm still not very bullish on them. I have to know more. I haven't done my research on them though yet. So I need to do more research on it. All right. Steve, I had a coworker that had some stock. He was getting excited because its value raised, but then was pissed because it said its stock split and lost its current value. No, it doesn't work that way. Yeah, stock splits don't, because if you owned a stock and it splits, you have the same value. If you have $10,000 in a stock and then it splits at 2-to-1, it's now worth, you still have $10,000 invested, but each stock is worth a little bit. It's worth half as much, but you still have the same amount of money invested. Now, what stock split can trigger, it can trigger sell-off, because it could indicate the company's needing money or wanting more people they want more investors. So they could be running out of cash or something like that. So it could trigger a slight dip, but overall, I don't think it's a horrible thing. Again, it's case by case. Okay, let's get back into this, because we've been into this for, oh my goodness, 46 minutes already. Okay, goodness gracious. I talk way too much. All right, let's get into, because as you guys know, this channel is all about answering questions. We talk about what's going on in the market, the economy, and then primarily right now we're talking about the stock market, and then my forte, what I would say my area of expertise is real estate, especially building real estate. And I want to talk about changing rental tactics, real estate investment tactics. So as you guys know, I always prefer to build my own places. And the reason why building is so not important to me, but it's ingrained in me, is because I can always get, or not always, but I typically get 4 to 5x my initial investment by building it myself. So for example, you guys know this, like right now I'm currently remodeling my house. And yes, I know it's kind of ridiculous because the house is only like 3 or 4 years old, but I want to change it up. Is that I put in rough cost is about $21,000. The siding and the style and the remodeling that I'm doing is going to be valued. I know the market's all over the place right now, but it's going to be valued somewhere between $80,000 to $100,000 increase in value for doing what I'm doing to the house. Okay. Now, same thing as when I built the place, or I bought this land. I bought the land because I made a video on it. I bought this land for $90,000. I did really quick work on it. Some permits, some digging, some testing, some engineering. That cost me about, $4,000 in about a week's worth of work. And then the next day, or the day after I did all that work, it was valued at $230,000, $250,000, something like that. Okay. And same thing with this house. The house that right here is I built it, and then I got it appraised, and I got a HELOC, as you guys know. And it appraised 3.5 times more than the money I put into it. And so that's my way of doing real estate. Now, that's the same way as when it comes to buying a rental and you fix it up yourself, whether you put on the roof yourself, whether you put in the kitchen yourself. You got to remember that whenever you pay a professional to do something, is that you are taking money out of your pocket, but you also have to give up your time. But with that all said, I've made more money building and remodeling my own stuff than paying somebody else to do it. Okay. Now, with that said, changing rental tactics. Long-term and short-term. So a lot of times what happens, and I've said this before in my videos, and I got to make another video to kind of go back on it, is that as an investor, you've always got to keep changing your tactics or changing your strategy. based on the economy. Because you guys got to remember that whenever we set out on a plan, we set out on a pathway, journey, whatever cheesy metaphor you want to say or use, is that you have to understand that things will always change, right? We talked about this in the last video or the last live stream. And there are things that are out of our control. We had no control over this or direct control over this COVID-19 issues. We have no direct control over what the stock market does or what the Federal Reserve does. But what we do have control is how we change and shift our strategies with the market or with things that are out of our control. And right now, a lot of times I've always encouraged people, or I've done it myself, I've looked for it myself, almost bought a multifamily residential home before this COVID-19 thing. Literally went and saw the place. It was horrible. It was awesome at the time. Post COVID-19, probably would have bankrupted me, okay? Because it was just like, it was a wedding venue, farm, big thing that would require tons of money, and then every wedding shut down, Airbnb shut down, everything shut down. So that it would have been horrible. I'm glad I didn't do it. But it's changing. No longer am I chasing, or I shouldn't say chasing. No, it's no longer am I going to be investing my money into real estate that is basic or standard, okay? And what I'm talking about, and I don't want to be insulting or like to other investors out there or anything like that, is like there's a lot of types of apartments or fourplexes or triplexes or even Airbnbs, right? Where it's just meant to cash flow. And a lot of times people think they overemphasize, and I know I talk about this a lot too, is they emphasize cash flow. They're like, oh, you know, as long as I make $800 a month on it, or I make $200 a month or whatever it is, I don't care what kind of building as long as it cash flows. One thing that you don't keep in mind, though, is that a lot of times is if you get a basic fourplex that's just kind of like built in the 60s, it's had basic maintenance done, certain things start to get replaced here and there, is that you bring in a very distinct group of renters, okay? And what that does is that it limits you, because typically if you, and this is well known for any type of real estate investor, is that if you have, for example, let's say in my area, $1,000 a month studio has a very different rental clientele or customers or tenants than a $2,000 a month studio apartment, right? Different incomes, different work histories, different credit scores, everything. And what ends up happening is that you don't have a lot of safety nets. And so when I was looking at certain types of multifamily homes or residential homes that were in that $1,000 range a month, it would have totally been suffocated by this whole pandemic, right? And because I've had properties, the long-term rentals that I have right now, and just coincidentally, not purposely, I've kept the ones that were high performing, that were more expensive for renters. I got people with much higher credit scores, nearly perfect credit scores, with very high paying jobs that haven't had any issues paying rent. And I've never had issues with them in partying or damaging anything. And overall, it's been a really great experience. And the same thing with my rental properties for short term. The ones that are higher end, the ones that are more expensive, it brings in people that don't damage my property, that don't party, and they're super respectful. Whereas last week, I just told you, one of my cheaper, less expensive properties, it got completely torn apart because a couple of folks went in there, got in really cheap, and they completely partied and ruined everything. Did over $2,000 worth of damage to walls, doors, mattresses, everything, okay? And so the tactic now is changing, where I am truly looking for property that are multifunctional, that can survive different markets, different types of markets. Whether it's long-term, I want to do is I want it be over $2,000 a month if I were to rent it out long-term. Short-term, it's going to be over $175 a night. And I don't want just one property that can just be like a single family home in a neighborhood. What I'm going to be doing is I'm going to be finding places that I can either make very, very unique for both long-term and short-term. Not too unique where it's like out of the ballpark where nobody wants to live there, but like converting an old church in a nice neighborhood smaller church or something like that, or an old firehouse or something that's more unique. Does that make sense? And what that does is it gives you a difference. And what I've learned here, especially with the shipping container cottage that I have, is that the more unique and the higher end, it's not luxury by any means, it's just higher end, it's nicer, is that you always create a market for yourself. And what ends up happening is if I had done the standard fourplex, making $1,000 a unit, very basic, is that I would have lost a lot of money. Okay, both in the value, the amount of maintenance I have to put in it, the type of renters that I attract. It hurts. It hurts me as an investor and a landlord. So changing business tactics, I'm no longer going to be focusing on those, even though if I get a really good deal on it, because I think those are the types of rentals that are going to be popping up. If I do end up buying it because it's just a crazy deal and I'm starting to see them pop up, I'm actually going to go look at one later this week. Is I will convert it. I'll redo it to make it nicer to attract a different type of tenant. Does that make sense? Okay. Remember, adapting to change, think like a business no matter what you do. And also when you're thinking about business, you always got to do, I don't think I've talked about this much, is that you always want to think about who your customer is and how do you adapt and adhere to your customer. Okay. And then do you want to work with that type of customer? I don't want to work with young 20-year-olds who want to party and destroy my properties. That's just not a customer or client I want to work with. If you are a respectful, responsible, career-driven, high credit score 24-year-old, yeah, sure, let's do it. Let's work it out. But that's how I'm changing my real estate tactics. All right, let's step into this. What's up, Alex? Irma and Gonzo. Compared to reverse split. A reverse split, yeah, I guess you could go like, I've never heard of a reverse split before. I'm not very educated in that. But yeah, I guess in theory, a company could have. Yeah, it's just called stock buybacks is what I'm thinking, right? If they just buy back, if they had 100 shares out and they bought back 50 shares, so then the 50 shares left the market, they double in price. Yeah, that's possible too. Mark, I read somewhere if you hold the stock for 10 years, you have 90% or better chance to succeed. This is true because I bought 1,000 shares of back in 2000. Ouch, Mark. You had 1,000 shares of Apple? At $1.42 in 2001. That I heard for you. What are they? That $300? What is that? 300? Yeah. $300,000. Ouchie. No, that's after their split. So you would have had more. You would have had $600,000. Yep, lesson learned. Hey, I did that same thing with Tesla. I bought Tesla at like $17. I didn't buy enough shares, and I sold it. I sold it in like 2012. When did I buy my? I think I sold it. No, I sold it in like 2009, 2010 to buy my property. Ugh, yeah, that one hurts me. All right, not sure if you mentioned this before. If you want to say, I'm in the Pacific Northwest. I don't like to share too much about my exact location. Part of the reason why I moved out to the country, but I'm in the Pacific Northwest. Gotcha. Yep. Okay. All right. So let's, if we don't have any other questions, let's jump into looking at Marriott Hotel here. All right. I already said just an hour, and I'm already hitting at an hour. So let me get this over. Whoop. I'm horrible at the timing of this. All right, so what we've got here, let me just pull it up right here. And actually, to save time today, I've already ran the numbers on this. And I know I don't normally do that, but I'll walk us through it. Did I not? The ticker symbol's MAR. There you go. Now I already ran this because I knew I was running out of time today, so I didn't want to go through all of it. But I just want to do a quick touch on the financials. We'll look at the different valuations for it, and then I'll show you what I valued it at, and then we'll take it from there. So Marriott Hotel, as you guys know, is one of the nicer hotels. It's been in business for, oh gosh, what was this? Close to 100 years. Either them or Hyatt. I believe Marriott's been in it for close to 100 years. A long time. Let's just say a long time. And they do it really, really well. They're one of the flagship hotels in the United States, actually globally. Okay, I haven't listened to their quarterly earnings. I haven't done this is all surface level stuff, but they're very interesting because, as you guys know, they got hit probably the hardest, along with all the other hotels, with this whole pandemic. I believe that they saw their occupancy rates go from like 80% down to like 10 to 20%. Okay. And if you guys know me, I don't stay in hotels and I'm super picky with my Airbnbs, just because working in the industry, I know how nasty certain places can be. I mean, I always bring my own sheets, I bring my own pillowcases, and I bring my own cleaning materials because I just know that certain people don't clean as well as they should. But with that said, a Marriott Hotel does a very good job, and they're well known and they're well established, and I do not think that they're going to go under. But let's take a look at their financials real quick, okay? So we're taking a look at them, and the first thing that we always go and look at is we always look at the amount of debt they have and the amount of cash they have. So as of right now, after Q1 2020, which is back in May, they have $1.76 billion and they have $13 billion in debt. Okay, that's not a great ratio right there because they cannot cover their debt. Okay, and then the next thing we want to take a look at is how much their revenue, the top line. This is whenever people say top line, this is what they're talking about. So the first line in the income statement, and it has actually not been growing very well. I actually wonder if we can look back a little bit further, 2015. And I bet you a lot of this has to do, and I don't know this for a fact, but I bet you a lot of this has to do with just Airbnb and HomeAway and VRBO really coming in and shaking up the hotel and hospitality industry. And if you guys notice, I noticed in my city is that Marriott and Hyatt, maybe a little bit, they've been building these other places that resemble Airbnbs or resemble apartments. They call them townhome suites, I believe is what they call them. But yeah, so they're trying to fight back with Airbnb, and they're even partnering up with them because you do and can find hotels on Airbnb now, which I think is kind of strange, and not truly in the what do you call it, in line with hosts. But I think that's why we see this dip here in 2018 and 2019 from 2017. Is this really where Airbnb really kind of spiked up? I could be wrong. It's something I have to dig in a little bit more into, but that's what I see. Okay, next thing is let's take a look at their cash flows real fast. Operational cash flows, financials. And we're kind of like always, we're looking at operating, right? And actually I dig in a little bit deeper. Their operating is looking good. I always take out their capital expenditures. And the reason why we want to take out their capital expenditures is that operating cash flows will show us, where am I? Here you go. Right here, this line right here, total cash flows from operating activities. It's basically showing us fundamentally, how strong is this company operationally. We don't care about their investing. We don't care about their ups and downs in other areas. Obviously, it can make a big influence on the company itself. But at the core of the business, the core competencies of the business, can they make money? And right here it says yes. But the other thing that we always have to take out is capital expenditures, which is right here. It's nice and convenient right below it. Capital expenditures are big expensive purchases, vehicles, buildings, properties, machinery, anything like that are huge one-time expenses that you have to depreciate over time. And the reason why is because there's certain businesses that require them to buy new vehicles, right? So for example, think of like Hertz rental. They have to buy cars. That's a huge expense that is not taken into consideration for their cash flow from operating activities. So you got to take that out. So we can see right here really easily without doing a lot of hard math, you can see that they're cash flow positive, even though Cash flows took a huge hit in 2019. Their revenue didn't drop that much in 2019, but their cash flows dropped a lot. So there's a big expense somewhere inside their income statement that causes huge. Do you guys see this huge dip here? You guys remember looking at their income statement? We saw that it peaked out in 2017 and it slowly dropped into 2018. I believe 2019 was even higher than 2018. But look at their total cash flow from operating activities. It dipped a little from 2017 to 2018, which is fine. We expect that because their top line dipped. Actually, it didn't even dip as fast as their revenues. But look at this massive dip here of nearly, what is that? That's nearly $800 million in cash flow, operating cash flows from 2018 to 2019, even though, looking over here real quick, where am I? Basically revenue is basically the same. So let's take a look. So now I'm going to dig in a little bit deeper. I'm going to see where that expense came from. I'm just looking for anything that's, so other revenue costs went up by, right here. This is basically where it came from. These two, or nope, just this one. That's roughly $700 million right there. So other cost of revenue, we won't know what that is here. We would probably have to dig into the annual report to see what other costs of revenue is. What could that be? Writing us something off? I don't know. Have to dig into it. Anyways, so that's basically what I do from the very beginning. Let's take a look at what they're currently trading at. I believe when I did this, they were trading at $89, $90 a share. Right now, they're currently trading pretty high at almost 40x. 40 times their earnings. That's pretty nuts. All right, and then as always, I keep forgetting to do this, and I need to make this a better habit. Let's go take a look at their balance sheet, because we obviously talking about stock splits and reverse splits, right? We want to see if they're buying back shares, because that is something that is a way to manipulate their shares or their stock price. So whenever it increases, you guys, it means that they needed money. So they released more shares to take money. So instead of taking debt, what they're essentially doing is they're diluting themselves. So let's say that you owned your own company and you had like 100 shares out, you owned 50 shares, and then 50 shares were given out to like family, friends, or coworkers or whatever. If you needed more money really fast, you would just let's say you create another 100 shares to then sell to other investors, okay? Now, you would still keep 50 shares, but now there's 200 shares total floating out there. So you diluted yourself, okay? But you allowed your business to create more cash. And that's what they did right here. They created almost, 13 million more shares? No, I'm sorry. This is in billions. So they created like 130 million more shares. And then right here, they bought it back. See? Ooh, sneaky. So whenever you see the price goes up or the number goes up, they released more shares to create money. And then whenever it goes down, it means they bought back shares. And when you buy back, when you buy back shares, is you increase the value of your stock because there's less shares out there. It's kind of like a split, okay, a reverse split. And so you can see every single year they've been taking their cash, the extra cash, and they've been buying back shares. They've been buying back quite a bit, almost 20. That's 20 million, right? This would be 363. Yeah, 20 million shares each year for the last 3 years. And that 20 million shares, let's see, if they're trading at 100, super fast math here, because I think they're trading at around 120. Where are we at? 120 times 20 million. What is that? 2.4. So that's $2.4 billion in cash each year, roughly, give or take, that they've spent buying back their own shares. That's a lot of money that could have gone towards their bank account, gone towards, updates, upgrades, business expenses that they didn't do. That's why we don't like to see stock buybacks like that. It's like, what else could you have done with that money? Okay, let's jump over here and let's take a look at Marriott. Where did I put you? There you go. Nope, right here. All right, so I did. Oh, actually, when I did it, it was currently trading at $85. Goodness gracious, what are they trading at right now? See, this is why you shouldn't listen to me. Just kidding. They're trading at 108 right now, so that is nearly 25. That's nearly like a 30% increase from when I did this. Now remember, that's because the economy opened up and then basically they had like almost zero revenue, and now they're at like, I believe they're like at 40 or 50% occupancy. A far cry from 80% occupancy, and as far as we know, there's not going to be a ton of traveling for the next year or so, or until a vaccine comes out. So this is all hype because we all know that their earnings this next quarter is going to be really, really, really bad. Okay. So I plugged everything in, and I already did this ahead of time. And the first thing that we always look at was we look at these two lines right here. Unlevered free cash flow to the firm. It looks like they're nice and positive, that they're cash flowing. We saw that dip here in 2019. And then we look at their free cash flows after they service their debt. And they do have debt. So when I did this, they had 11. They must have gone up recently then, huh? It did go up. So they pulled out more debt. So right away, so I did this just not too long ago. You can see that they had $11 billion in debt, and it jumped up nearly $2 billion. I guarantee you they took that out very, very recently because of COVID-19. So if we change this here right real quick, 13, whoops, what did I do? 13.08. And then their cash, yeah, absolutely. They took that, basically that debt went straight to their cash. Because I took, where did I get that 10? Huh, I have to look at that. Okay. And then going down here, these discount rates, remember these are the two areas that we look at. This is, as a value investor, this is the area that you have the most control over, is the discount rate and EBITDA multiple. As a reminder, discount rate is basically the risk rate that you're giving a company for future earnings. Like how risky are they? Or how risky are they? A standard is 8%. If you did it just across the board, publicly traded companies, 8%. And the higher the risk rate, the more dangerous or risky they are. Okay. I gave Marriott because they're so well established, they're so well entrenched, and eventually I think they'll do just fine. I gave them a 6%, so I took off 2% from the standard. For the EBITDA multiple, same thing. Standard, very standard EBITDA multiple across the board is around 8 times. EBITDA, and remember, EBITDA is just this line right here. It's a fancy business jargon word. All it is the profit that you have after all of your revenue expenses and expenses of running the home office. So think about salaries, marketing expense, advertising expense, paying your cleaning crew, rent or leases. Yep, you pay rent or leases. You would not include mortgage payments in there, right? No, you didn't. You include the principal payments, not interest payments. Okay. And that's what you get right here. You get EBITDA. And this multiple, usually at 8, and the further out you go is you're giving more confidence in that company being able to generate those numbers. Okay, so I gave it a 12 because Marriott's been around. I think they're really well ran. I gave them 12. And even with all that, and giving them a negative 40% decrease, right? This is the growth rate that I think that they'll see in 2020. I think that they'll go from $21 billion in 2019 for 2020, because obviously they were shut down for what? March, April, May, right? Roughly 2.5 months, 3 months. And then for the rest of the year, they have another 6 months left. They'll be operating right between like 40 to 60, maybe say 50% occupancy. So I think it's fair that they will be right around maybe 12.5 to maybe $13 billion in revenue this year. And then I think that 2021, this is assuming that a vaccine comes in, things start coming back together. It's going to skyrocket back up. It's going to jump up to back to $20 billion, basically where they were at in 2018, 2019. And then it's going to keep on growing as traveling picks up again. And then they're going to end in 2024, 5 years from now, at $33 billion. That's actually very optimistic considering what's going on right now. But let's give it to them and let's say that happens. I value their share still at only $80 a share. Okay, so that's a far cry from what they're currently trading at of $108, right? And one thing, I've said this before, we've talked about, it's not me saying this, this is a lot of other analysts and people, that the market pre-COVID-19 was so exceptionally overvalued. And overvalued means for every dollar a company makes, how much an investor is willing to pay for that. Okay. And there's a baseline for valuation. So like certain industries, you're willing to pay 15 times. So for every dollar a company makes, you're willing to pay like $15 for it. And then certain other companies, you might be paying $30 for it, right? Think about like really big companies that are super profitable, like Apple. But then what ends up happening is if you take the market as a whole, like let's just say the whole market generates $1. How much is everybody willing to pay for that $1 if investors? And then you can track that and see over time how overvalued or undervalued the market is. And pre-COVID-19, it was super overvalued. The entire market was, if I remember this correctly, it was at like 16x. So for every dollar the market created, investors were willing to pay $16. Man, it just started to rain. It's gonna make it tough to work outside now. But now though, post-COVID-19, businesses shut down, unemployment rate at 13%, which is still crazy high, is trading at like 20.3x. So it actually went up. And this is a great example right here where Marriott is one of those companies that got hit super hard, right, by this whole COVID-19 thing. No more traveling. There's a lot of countries and cities that don't even allow international travelers right now. Is getting punished in the fundamentals, how much money they're actually generating. Yet the market, right? My fair valuation is saying that they're worth $80, but the market is saying that they're worth $108, okay, a share, which is quick math, 28. That's like 33% overvalued from a fair valuation. Like, so let's see how insane we would have to get this number down to get to reach 108. So let's say I go down to 4%. This goes to 15, 13, 3%. There you go. So I would have to bring this discount rate just to match what they're currently trading at, is that you're giving a discount rate of 3% and an EBITDA multiple of 13x, which is really, really super generous. That's like that's like something these are numbers that I would give like a well-established company like Microsoft. Okay. Not like that's not even getting really hurt in this industry. That if any, or during this time period, they're actually flourishing because of like their cloud compute, not the cloud computing, what is it called? Their software programs and their subscription-based software like Word and Excel and stuff now is subscription-based. And then they have that, what's that called? It's competing with Slack, Team, right? But Marriott, who is competing with Airbnb and is being hit the hardest by this COVID-19 thing, I think a more fair is, even if I give it 5%, and this is at 12, they're still at $85. So that is where I'm at with Marriott. We will see. And why I'm doing all this, before I jump into all this, let's just take a look at Marriott here. Ooh, they actually went up. After hours trading, they're at 110. They peaked out 117. This is so insane. Our market's so crazy, you guys. I don't even know anything anymore. Okay. So Morningstar is valuing them at 115. Let's see what these guys are saying. Valuation. Okay, so they're these folks over here, this is 38 different analysts from across the board. They have them valued closer to where I'm at 65, 85. So they're even less than me. They're even more bullish or more bearish than I am. So let me just see what they're saying here. Yeah, see, debt isn't well covered, highly volatile, profit margins are lower. See, these are exactly what we were just saying, right? The profit margins, I didn't like what I saw from 2018 to 2019. The share price is volatile, but we understand why it's volatile, right? Because of the current conditions. But yeah, that debt has me super concerned. So anyways, what was I saying? I was saying something about Marriott. I totally forget. Let's jump over to questions. All right. Yeah, I didn't want to dig, but thanks for sharing. Sure thing. What's up? Are you next? Do you only trade on the New York Stock Exchange? I do. Right now, that's all I am. I'm not a huge stock trader or investor. I shouldn't say trader. I'm not a trader. Investor. I typically use stocks as a small portion of my overall portfolio. Most of my portfolio is, as you guys know, it's real estate. And I use stocks and when I see really good timing to enter or I can buy things up at a good discount, which is right now I don't see anything, I'll buy it up. And like I said, I could be wrong because I'm betting against the market and I'm getting crushed right now because the market is hitting record highs. That's the other thing I want to talk about. Remember when I talk about record highs for the market and we see everything driving up, we've got to remember that the top five companies, maybe 6 companies in the S&P 500. So out of the 500 biggest companies, most profitable companies in the United States, 5 of them, so 1%, that's 1%. 1% of them makes up 20% of the valuation of all 500, okay? So that's the 5 is Microsoft, Apple, Facebook, Amazon, Alphabet, which is Google. Okay, think about that. Those 5 are the 5 that are doing really, really well in this market. So if those 5 are doing really, really well, the S&P 500 is going to follow it because it shows like, oh, the S&P 500 is doing super, super well. But that's because the 5 biggest ones control 20+% of the overall market. I think if you go down to like the top 10%, now you control a third of the market. Okay, so I think that includes like Johnson & Johnson. I can't remember off the top of my head. I'm sorry. Oh, JP Morgan's up there. But yeah, if you go to the top 10, now you're talking about owning 33% or representing 33% of the overall S&P 500. And what we forget is that there's 490 other companies that aren't as strong or do as well. So even if 300 or 200 companies are just a complete crap show, right? Not doing well at all. The top 10 companies in S&P 500 can hold up the entire stock market, right? That's not a good thing. It's not a true representation of what's really happening to everybody. It's like saying Bill Gates, Mark Cuban, Warren Buffett, and Tim Cook. They're doing really, really awesome. But then you're like, yeah, but America's not, the middle class Americans aren't doing really great, but everybody's like, yeah, but they're doing really well. It's kind of like that. Okay. Taro TV. I have not bought Bitcoin yet. I am going to though. You know what? Where is it? Not free stock. Go back here. What are they trading at? I want to see what they're trading at. I will buy into them. I should have bought them the other day when I saw them dip down to 8,000. Yeah, it was right around here when I was thinking about buying it. I should just start buying into. I have never bought Bitcoin before, but I totally will start doing it just because I've told you guys about the asymmetrical risk of Bitcoin. Remember, asymmetrical risk is when the reward so far outweighs the risk that you'll do it. So I don't know much about Bitcoin. I don't think Bitcoin will be the answer, but looking at it, how there will never be more than 21 million, or correct me if I'm wrong, Turtle TV, but I don't believe there will ever be more than 21 million Bitcoins ever created, okay? And then on top of that, we know that a certain amount of Bitcoin has just been lost because people purchased it and they just didn't know about it. They left it on their computers. They got rid of their computers. They don't know how to access their wallet anymore. And so we believe that nearly 3 to 4 million of those Bitcoins are gone. We also know that a large majority, maybe 5 to 6 billion or million Bitcoins, are owned by a few very, 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 very wealthy individuals or companies. That leaves roughly about 12 to 15 million Bitcoins left. And in 10, 20, 30 years, it's very possible for Bitcoin to increase to $100,000 or $1 million per Bitcoin. Okay. And with that potential, if it costs me, I guess right now it's nearly $9,500, am I okay losing $9,500 to make $1 million 20 years from now? And will that hurt me? And the answer is not really. I probably in 20 years I won't even recognize a loss of $9,000 or $10,000, right? But I also have to understand that it's basically a flip of a coin where it goes up to $1 million and maybe greater than a flip of a coin, but there's a high chance that I just lose out. It just goes down to zero. So, but because of the asymmetrical risk there, it's worth just buying a Bitcoin or investing in Bitcoin and getting into it. But if I'm correct, you don't have to buy a whole Bitcoin. You can buy parts of a Bitcoin naturally, right? Yeah, I agree that Bitcoin is purely it's speculation because there's no value in it. That's the reason why I really hated Bitcoin. And I shouldn't say I hate. I disliked and didn't trust cryptocurrency is because there's no true valuation behind it. It's not like I can value it by looking at like, hey, this is how much people want it. This is how often people use it. This is backed by gold, or this is the true value. It's all it is based off of when we look at Bitcoin. It's truly just whoever is buying and selling it. That's what's causing, you guys can see this number going up and down right now. That's all it's based off of. And so if somebody who owns a large majority of Bitcoin decides to dump all of their Bitcoin right now, we would see this number drop really, really fast. That's all it is. There's no valuation. There's no cash in the bank account. There's no cash flows that we can look at. There's no gold bars that we can hold on to. It's all purely based off investor confidence. And that makes me nervous. And the other thing that makes me really nervous is that cryptocurrency isn't really used, right? I don't see anybody using cryptocurrency to go out and buy a Starbucks, or I don't see cryptocurrency being out, even though it's accepted in a lot of places. You don't go buy a new Ford Mustang with Bitcoin or with Ethereum. You don't go buy a house and go to the bank and say, hey, I've got X amount of Bitcoin I want to use to buy this house, right? You always have to convert it over to a certain standard currency, whether it's a dollar, it's a euro, or whatever. So yes, I'd say speculation. Ticker symbol. Oh, that's right. I got to do Light. They own 90% of the market share globally for making microchips for Android phones. Oh, I see. Okay. Toro TV on Robinhood and Apple phones. Yeah, so Toro TV just announced. Yeah, so it's 20 million is the max. The creators lose 1 billion. What do you mean lose 1 million of Bitcoin, Taro TV? What do you mean by that? Jen A, there will only be a set number of Bitcoin because there's times when it forks so you have Bitcoin Cash. Beware of fake coins that use the BTC name. So Jen or Toro, the folks that knows more about Bitcoin, is there a way to get scammed out of buying Bitcoin if you buy through a platform like Robinhood or SoFi or like a legitimate platform like that? How do people get scammed out of buying Bitcoin? Hey Gen F, what's up? The dollar is printing out of three. The dollar, you're right. The thing with the dollar though is that you got to look at the investor confidence behind the dollar. Is that you don't just have it's the staple of the U.S. market, but you're talking about 70% of the global market. Now, if you did that with Bitcoin, if you swap that real fast, I'd totally be behind Bitcoin. I'd still have some hesitancies. I still have hesitancies behind the U.S. dollar ever since we got off the gold standard back in the 70s, right? I don't agree with that. But the thing is that everybody accepts it. I can take a $100 bill and I can give it to basically any human being. Like, for example, when I was in Vietnam, I ran out of what's it called, the Vietnamese dollar, dong, right? And all I had was U.S. currency on me, right? And I was in a really tight bind. I was about to miss my flight. I was able to pull out $20 bill, hand it to somebody in the middle of nowhere, and they gladly took it. Okay, I don't think you could do that with the yen. I don't think you can do that with the Canadian dollar. You can't do it with the Australian dollar. Nobody else would do that. But with a $20 bill, the US $20 bill, you can do that. And if you can do that with Bitcoin, for example, I think that you would see the same thing. It's kind of going back to the whole thing, right? With like gas, electricity, or hydrogen. It's like if you have a hydrogen car, but nobody really accepts hydrogen, even though it's a great thing, it's awesome, it's super efficient, nobody's going to use it because it's not widely accepted. Electricity and gasoline are kind of the standards right now. I don't know if that's a really good metaphor or not. All right, 100K Bitcoin has seen since 2007. Takes cars. Yeah, Mark, I agree. Most mortgage companies don't take Bitcoin. Bitcoin did see 20K. They saw 20,000. I believe it was 2017, not 2007. I think you might have meant 2017. Yeah, Bitcoin has sky's not the limit, but we're talking about in decades down the road. And the reason behind that is because there is a limit. So like anything else, they're like the US currency, you just print more money, right? The euro, you just print more money. Everywhere around the world, people are just printing money. Bitcoin, you can't do that. And what people are starting to understand, especially with China coming on board, they are working on digital currency. We know that for a fact, okay? Is they're trying to create something. We don't know if it's going to be a cryptocurrency. We don't know what it's going to be like exactly, but we do know that they are in the midst of creating something that's a digital format. And if China does it, we can definitely bet that the US will eventually have to do it. And to be honest, digital currency, whether it's Bitcoin or something of the like, is going to have to replace the dollar. It has to replace cash and credit someday soon. We don't know what day or how soon, but we know it has to. And right now, Bitcoin is the best representation of that. And if that becomes a new standard, let's say that China releases a digital currency next year, and people lose faith in the dollar because we're just printing it like it's nothing. Bitcoin or things of the same or of the like could become the new standard. And if that does happen, if it does, a small chance that it does happen, we could see this go into hundreds, thousands, maybe even in the millions. Right? Not tomorrow, but possibly in 10, 20 years when there's only 21 million, maybe even less than that, 15 million that are available to the public. Okay. So again, not super likely, but in the likelihood that it does happen, it could be worth a lot of money. That's all I'm saying. And him having 1 billion that are locked. Oh, I see. Okay. Yeah, I agree, Mark. I think that we're a long ways away from crypto, but I think that it's very possible that if we see other countries, especially our competitors right now, like China, they start in the other thing we have to think about is that it's not just here in the United States, is that the US carries a lot of weight in the financial world because people want the dollar. Now, if China goes out there and starts taking away because people would rather use what I don't know what they're going to call it, the Chinese digital dollar or their digital currency, the US will have to compete. It's kind of like businesses competing with one another, one-upping each other, right? And so if everybody would rather use the digital currency from China, or not everybody, but let's say that like a couple nations or a couple businesses, the US will start coming in there to offer something even better, something more secure. Okay. My guess anyways. So Jen A, talking about Bitcoin. Lots of ways to get scammed. People will trick others to send the currency to another wallet. Phone hijacking, where someone transfers your number to their phone and use it to get to you. Oh, I see. The American economy runs off debt. Printing more money creates inflation, which forces you to reinvest back in the economy. If you replace that with people could hoard it. If it was replaced with Bitcoin, people could hoard it. People could hoard Bitcoin. If you had to use it to buy stuff, though, so let's say if you went to the grocery store and you were able to just to use your phone, kind of like Apple Pay, and you just tap your phone or whatever, and you used your Bitcoin, it could become a standard currency. This is all just in theory, though. to the point that no one wants to use it. Yeah. It's just, it's harder to use. Nobody really accepts it, even though I know like Starbucks, I think Tesla came out and said that they use it. I think the reason why people don't want to use it is because it fluctuates so much. That's the only thing. There is one company that, I forget the name of it, where you put your money in there, similar to Bitcoin, but it's backed by gold. So you put like, let's say you have like $10,000, you deposit $10,000 and the company literally has $10,000 worth of gold that is yours. And then you swipe your card just like normal, and it takes away from that $10,000 or whatever the value of that gold is. So some days, if you haven't touched it, it could go down to like 9,500. Some days it go up to 10,500. It fluctuates just like you guys are seeing here with the Bitcoin. And but the point of it is that you're using a credit card that's backed by gold, which I find very interesting. Oh, really? I didn't know that some crypto YouTubers got their stuff stolen. That's crazy. What was your question? Are you next? I'm sorry. Let me see. Are you next? American Congress. I didn't see your other question. Type it again. Oh, I see it. Crypto has no intrinsic value. It's pure speculation. How is gold any different other than being physical? That's a great question. I've considered that question a lot too, and I agree with you. Crypto has no intrinsic value. There's nothing that you can. Same thing with gold. I've often said that gold has no intrinsic value, but it's that same thing that we're talking about the US dollar where everybody accepts it, right? Like I said, with that $20 bill in Vietnam, the woman just grabbed it and was like, absolutely, thank you so much. Didn't even care that I didn't pay her in her own country's currency, right? And actually, in a lot of Southeast Asia, a crisp $100 bill is like gold. And I say that because gold is even more widely accepted. Now, let's say that I went somewhere and I handed somebody like a nice, gold bar, right? A gold bar worth like, I don't know how much they're worth, but let's say a gold bar worth $1,000. You can probably buy almost anything. If they could test it and they knew that it was 100% real gold, a lot of people would accept it. And the reason behind that is because gold is a standard in just human economy and human history. But outside of that, gold does have some standard things that it can be used. It's great for wiring. It's made into jewelry. It can be used in electronics. Like gold is actually used in a lot of electronics that I wasn't aware. It's a great conductor. But other than that, it's also backed a lot by just human investor confidence, human confidence. So other than it being physical, I agree with you. There is no intrinsic value in gold. Same thing as like diamonds, for example. Diamonds are not rare. Anybody who tells you that diamonds are rare has fallen for the marketing scheme of the De Beers company, because now we can actually make diamonds that are more perfect and even better than raw diamonds. But diamonds are still super, super expensive for what they are. So it's always about investor and human confidence. It's raining so hard. I'm not going to be able to work anymore. So I'm going to be in here hanging out with you guys. Okay. They do use gold in circuit boards. You read my mind, Jen. It's also globally accepted, agreed, but no one trades in gold. People do trade in dollars. If gold drops to a fourth of the price, I still have no reason to buy it. What's up, Ray Ray? Diamonds are forever. That is what they tell you. Diamonds are forever. Ray Ray, why'd you retract your thing? If gold, I agree with you. I just started buying gold. Where's my portfolio? I should be buying more gold. So this is my bet against the market, and this is me experimenting. So I did buy. Where is it? Right here. These two. These two are the my gold shares that are actually in. I did some research. These are the two good ones, but in theory, these two companies, they actually back up gold in vaults in London. It sounds like a scam, but apparently they're pretty well backed ETFs. That their ETFs are backed by the price of gold in London. So diversifying, and we have, hundreds of years of data on gold. People always want to trade gold, and it's where most investors go to hold their wealth. So I'll do it. I'm assuming if I'm willing to invest in like these other companies, gold really is no different. I say that with a little tongue in cheek because obviously gold is physical and it has no cash flow, but you get what I'm saying. Okay. I need to do, what is it? Light, right? All right, let's just take a quick look at the financials here. Light. Lumentum Holdings. All right, so they are trading at $80. So let's just jump into here real quick. Let's look at their PE ratio. Whoa. Okay, so I can tell you right off the bat that this is probably a growth. This was a growth company, right? Yep, mid-growth. And how I can do that for folks here, see right here, price to earnings. Whenever you don't see a number in the PE ratio, it means because it was negative. And if it's negative, you can't give it a PE ratio. And then when you see huge spikes like this, it means they had a secret or a pop-up like what do you call it? Surprise earnings, and the earnings was so small, so crazy small that it has this insane 644 PE ratio. And then they went negative again, and then they went slightly positive. Actually, they were really positive here because there was only a 10x, and then it went negative, and then right now it's trading at 55x. So let's take a look at their financials real quick. So as a growth company, remember growth companies, you give up cash flow and profitability for fast growth and cash flows tomorrow. Eventually, then how in the stock market used to work anyways. Actually, I shouldn't say that. In the long run, it should work this way, is that you're investing in cash flows. You're investing in how profitable a company is. And growth is saying like, hey, keep giving me money, keep investing in me. And one day in the future, I will give you a lot of cash. But right now, you're investing in me for my tons of growth. So think about like Facebook and Amazon, right? We just saw their growth go right here. Looking at this, again, just looking at it, is I don't see a ton of growth as a growth company. I see okay growth of 25% from 2017. Let's just jump in here real quick. Yeah, like it's really modest growth for a growth company. But let's keep looking at their cash. They've got some cash, good enough cash to cancel out their debt. That's not too bad. That's good. Their operating cash flows are decent. Let me just take a look at their... So what I'm doing here is I'm going to their operating cash flows right here, and I'm taking out their CapEx, and they're still profitable for the most part. Okay. So fundamentally, the business itself it's okay. It's not strong by any means, but it's like on a scale of 1 to 10, I'd give them like a 6 on, maybe like a 5 or 6 on their financials. Let me see. I do not know. Are they based in the U.S.? Where are they based out of? Company is, nope, it's California. Okay, provides 2 types of optical that are used in telemarketing, networking, commercial lasers for manufacturing inspections. So they must provide stuff for the cameras then and the cell phones. That's what I'm assuming. Now, this is stuff that you can dig into their corporate or their quarterly earnings. Is that and even their annual report is you want to see how much of their business comes from Apple and Android. And the reason behind that is because if a substantial amount of their revenue comes from Apple and Android, that's not a great thing. It is as long as Apple continues and Android continues to use them. It's not good if Apple and Android comes up with a new technology or deciding we'll go with a different supplier. And we know that they can be really finicky with their suppliers and where they get their stuff from. It's just whoever can bid at the best price. So overall, they've been increasing in price fairly well the last, 2005, 6 years? Yeah. I would say that this company is a speculative company. Let's just take a look at them right here. It's not gonna. Whoops. It's not gonna be as speculative as like Nikola. Nope, not Litecoin. Momentum. But yeah, so they can't even Morningstar. So other folks can't even value them because they have. It's basically because they have negative cash flows. So it's speculative. It's hard to value a company if it's worth $80 or not based off of no cash flows or consistent cash flows, which they don't have. It could be if you have some knowledge or some news that they have like a big contract with like Apple and Android, and they're going to use them in future iPhones and iPads and everything. Then yeah, I'd be like maybe toss some money into them and see. It's not my cup of tea, but yeah, possibly. I say that, and I didn't say this to you guys. My friend who is I played Dungeons and Dragons with, he just made. I don't want to share this with you because I don't want you guys to go out and do this. But he just made $250,000 this month trading options, and I was talking to him about trading options right before he did all of that stuff, and I didn't want to trade the options that he did. He made $250,000 off of $20,000. Insane. It's like one of those things where it's just like, hey, I went to the casino, and I made a lot of money, and it's like, yeah, but that was you got lucky, dude. You got super lucky. He's not trading off fundamentals. He's trading off of what he thinks the news will release, or he gets some sort of like news tip or something like that, and he's trading in companies that are like worth like $2 or $3, and it spikes up to like $4.50 or $5. It's just too crazy. But let me see here. The market price is the price. Okay. So with that said, let's answer some questions. I want to get to a couple of last things here before I wrap this up. Goodness gracious, it's almost been 2 hours. Okay. Taro, try to take $1 million of a dollar out of the country in Bitcoin easy. That's true. It is easy to take it out of the country in Bitcoin. That's very true. Also true, Mark. Yep. I think if I remember the Silk Road, a lot of it was done through cryptocurrency, right? I think that's probably a lot of problems with the problem that people have with it. Okay, Ray, analyze Kinetic B and Volvo B. All right, I don't know what Kinnick. I'll do one because there's one other thing I want to do. Volvo. B? Which one is B? This one? Is it this one? The Volvo AB, the second largest manufacturer of heavy-duty trucks and diesel engines? While Ray gets back to me. You said you only trade on the New York Stock Exchange. I just realized South Africa is listed there too. Would you trade with internationals? It crashed actually, but it's already recovering. International stocks. So do you guys remember one thing about me and a lot of value investors is that I guess I'm kind of speaking for all of us generally, is we only invest in things that we understand or things that we have some sort of control or understanding of. And the reason why I don't trade in the Chinese market, I don't trade in like these emerging markets, right? In Russia. And I don't know about South Africa. I don't know. It's just for one, my knowledge is very, very shallow in emerging or different markets. And two is there's certain markets like Russia and China where I don't trust the contextual government. And so just like right now, how we're seeing a lot of volatility in just where I understand the U.S. market to a sense, right? I understand the economy, I understand business here in the United States. I understand the traditions or the standards of business. I understand how we do finances and financials in the U.S. And therefore I can not confidently, I'm better suited to invest in U.S. companies. The thing with Chinese, Brazilian, Russian, or South African companies or stock exchanges is that I don't understand their standards. I don't know what context could change in China, or what strings are being pulled, or how they're messing with the numbers or messing with the corporations. And I could be even wrong about that, but just the fact that I don't have that confidence over there, I don't want to put money over there. And that's a large reason why I don't. And I know I'm leaving money on the table. I absolutely know that. It's the same thing as how my friend who just made $250,000 in May, I still stand by my choice. If I had to go back in time and do it again and put myself in that position, I honestly, I couldn't say that I would do it because I didn't understand those companies, and I'm not about to invest $20,000 on a waiting for a news article to come out. It has nothing to do with the company's fundamentals, has nothing to do with the leadership of the company, has nothing to do with them coming out with a new vaccine or anything like that. It was just a news article. Some journalist released an article. And so it's not my style because, 8 out of 10 times I've gotten burnt. And that's why I wouldn't do that. But those 2 times that worked out, I could have made, $250,000 off my $20,000 gamble. But with that all said, is I don't understand enough about the Chinese market and the Russian market or South African market or those businesses. And if I don't understand it or have something that I can grasp onto, I don't invest in it. And that's probably why I'm not a big investor in stocks. I'm more investor in building real estate because I understand property, I understand land, I understand how to build stuff, and I understand what renters and what homeowners want. But I do it because it's interesting, it's fun, it's what I went to school for, and you can make money on it. Let's see. So you call it this. Yes, it is. Okay, so quick one right here, Volvo. So let's take a quick look at the financials. Let's see, they're trading at 16. All right, so we can look right here. We see that they are trading at a reasonable price to earnings ratio, and it's all positive. So we know that they've been making money. That's good. We scroll down here. We take a look at, holy cow, they've got a bunch of debt. Okay. They have $173 billion worth of debt. They also have about $65 billion in cash, which would cover, what is that? A third, roughly, a little bit more than a third of their debt. All right. Their revenue has been growing steadily. Let's look at their earnings per share has been growing. Operating, let's take a look at their operating cash flows real fast. Where'd it go? Did I scroll down too fast? Where'd it go? There it is. Okay. So their cash flows are looking good right off the bat. Let's see, they're growing at, so this minus this, so they're spending a lot on CapEx. But they're also selling. So they're buying and selling a lot of CapEx. So that's 14 billion that year, 14 billion, 19 billion, 25 billion, 24 billion, 29 billion. Okay. So their operating cash flow has been pretty steady. That's good. Let's take a look at their balance sheet real fast. And let's take a look if they're trying to manipulate their stock. It looks like I can tell right now that they're not. Yeah, so they've been holding steady. They're not They're not releasing more shares to raise more money, and they're not buying back shares to mess with their prices. Fundamentally, this looks like a strong company. Let me just see. Oh, they sell all those cars. Did you guys ever watch that Jean-Claude Van Damme commercial with the Volvo trucks that are going backwards, and he does the split? Oh, I watched that like 24 times. I'd pull it up here on the screen, but it would get me flagged on YouTube. But if you guys haven't just type in Jean-Claude Van Damme Volvo commercial. It's one of the coolest commercials I've seen. So the cool thing about this is that Volvo, I remember seeing buses, like all the buses in my area are all owned by Volvo. The only big thing that I could see coming in and disrupting Volvo, which I think I'm not sure Volvo's in that industry yet, is if a company like Tesla by 2030 has electric buses, right? And we do know that there are buses that are geared towards biodiesel or other types of fuel types. And I'm not sure if those are Volvo cars or Volvo engines or not, but it'd be interesting to see what ends up happening. I know construction equipment, I see a bunch of Volvo motors and a lot of heavy construction equipment. Aircraft engine components. It's weird. You have all this transportation motor stuff, and then you have financial services. It's very interesting. Let's see what they're priced at. Volvo. VF. Sorry, y'all. Huh. You can't find that, huh? Why can't they find this ticker symbol? Oh, this is a Swedish company. Okay. It's not traded in the US stock market. That's why I can't find it. Got it. Overall, Ray, I think purely fundamentals wise, it's really strong. I'd give this one like an 8 out of 10, 7.5 out of 10. What was it? Let me take a look. The only thing that I don't like is the amount of debt that they have but they have a strong amount of cash. Their cash flows are strong. I didn't dig in to see how much of their cash flows can service this debt. I do not like to see like this debt has increased by $50 billion within like 3 years. That is increasing faster than their cash in the bank. Perhaps, let me see, 36, that's 30 billion. I guess it's going at the same rate. That's just a ton. But to be fair, they make a ton of money. They have a lot of revenue in there too. So, their net income is increasing steadily. They had a big jump in net income. Yeah, I'd give them like an 8 out of 10. 7.5 out of 10 just because of the debt. That's the only thing I'd highlight. And so if I was to look deeper in this company, I would pull up their annual reports and I would look and see where this debt is coming from, what they're using it for, because I thought maybe they were using it to buy back their stocks, but they're not. But they do buy a lot of capital expenditures each year. So I bet you that this is going into that somehow. They probably took out a couple billion extra perhaps this year just to kind of push through what's happening right now. I would also take a look and see what they're planning on doing for to compete with the new electrical movement. But considering that they are focusing more on the commercial side of stuff, I don't see construction equipment, I don't see marine equipment or even buses converting all over to electric anytime super soon. I think we'll see a lot more motorcycles, cars, that type of stuff going electric. But I think Volvo is in a fairly safe environment for the time being. But it'd be nice to see that they are planning to play in the electrical field too. That's a weird thing to say, but yeah, good fundamental finances there. All right. Nice. You got them. What are they trading at 16? Yeah, I'm sure like everybody, if you got in at $13, that's pretty darn good because I think, whoa, what's going on here? Okay, there you go. Oh, they've just been trading basically sideways. Do they pay out a good dividend? Dividend. Okay, so they pay out a decent dividend. Yeah, I wouldn't say that you're going to make a ton of money on this. If they've just been trading sideways since 2008 is at a couple bucks, went back up, spiked at $20. And then you see how it's trading sideways? It's going to continue to trade sideways then, unless something significant happens. So basically, this is more of a dividend stock, a solid dividend stock where you get dividends looks like they're releasing it every year. So you get a dividend every single year, and you get a steady basic company where you just hold on to your money. So if you are okay with that, let's see, they did $1, so they're roughly, what is that? 5? 5, 6, what was that, 5, 6%? There's an easier way for me to do this. Why don't I just look at the yield? How come it doesn't show the yield right here? Huh. Usually it would tell me the dividend yield, but it doesn't. But if you're looking, I think it's about 5, 6%. Recalculate my math there. So if you're looking for a good dividend stock, I'd say this is a good dividend stock. But it would not be a good growth stock or like increasing your wealth or seeing a big return in terms of the actual stock price. Because you can see right here, you might go up. You might see another peak at 20, right? You might sell it, possibly. I don't know. But if you just hold on to it and just keep dumping money into it and just getting that 5-6% dividend yield, it's not a bad investment. Okay. See you later, Toro TV. Thanks for jumping in. Yeah, of course, Ray. Okay, so the 21 of you that are still in here, thanks for sticking around. And I know I said this was going to be a short video or live stream, and here we are, all into it. 2 hours. Now, there's a couple things. Towards the end of my videos, I like to leave you guys with a little bit of a message that I've learned from being in the market, from my mentors, from my professors, and from other people that I really look up to and enjoy being around, and that I think that can help you, because I think most of us who are in this channel right now, you guys and gals are really trying to create a better life for you. You're learning, you're taking on new things, and especially in times right now, it's a time for us to do that. And I want to talk to you about being able to understand your weaknesses and knowing like how difficult it can be to take that next step. And I was thinking about this right before I came into this live stream. So, when I'm doing my building and my remodel projects, most of the time, 90% of the time, I'm working by myself. And it's so excruciating slow working with just one set of hands. And it's always about taking one step at a time. And I know that same thing for finances, because in the grand scheme of things, we look at individuals around us and we compare ourselves to other people. And I do it too. And even though I say you shouldn't do it, and you definitely shouldn't do it, but naturally we're human beings and we compare ourselves either to ourselves or we compare ourselves to others. And a lot of times we see people at where they are at right now, snapshot, or what they're showing off. And we don't see everything behind them. And a lot of stuff that I talk about, and I'm very transparent with the money I've made, the money I've lost, what I have, what I don't have. And a lot of times people think like, oh, that's really fortunate for you. You're really lucky. And what you don't see, or what a lot of people don't see, is that I'm 35 now. It was about 15 years in the making. That's not like an overnight success. And I wouldn't even say that I'm even close to an overnight success, because I'm still a far cry from where I want to be. But with that said, it's that it takes one step at a time. You solve one problem at a time. And a lot of times when we're trying to get out of debt, we're trying to minimize our expenses. We're trying to make more money. We're trying to get promoted. We're trying to pay off our school loans. Is that it's really difficult to focus on all of it at one time. And instead, focus on one step at a time, knowing that if you do one step at a time, it'll get you closer to where you're at, instead of trying to focusing on all of it. And I think it's especially important when it comes to finances, because finances dictates your whole life. Now, I'm the first to say that money does not make you happy. I've given up a lot of money in order to live the life that I have. But I was able to do it by taking it one small chunk at a time, starting at the age of like 21 years old. Okay. And here I am. I was able to, at 30, actually it's 27 technically, but at 30, I was able to live the life that I truly wanted, away from the work environment, away from corporate life, because I took it one step at a time. And right now, I'm doing my remodel project, and that's a good metaphor or analogy. I never know when to use that, but it's a good analogy or metaphor of taking it one step at a time. I'm on this time crunch. I need to get things done. And a lot of times you can get stressed out or overwhelmed if you look at everything. Okay, so chunk it down. What do you need to do with your life? Do you need to minimize your expenses? That's easy to do. Start cutting back. And I think a lot of times we think that we have to reduce our expenses by $1,000, $2,000. I need to increase my savings by $10,000 or whatever your number is. Instead, I still nickel and dime my monthly expenses by $5, $10. $2, even my Netflix account, right? I don't need Netflix, Amazon Prime, HBO Go, and Hulu, right? I mean, those are, in the grand scheme of things, $5 here, $10 there. It's not a big deal. But I'm constantly getting rid of subscriptions that I don't use, calling my insurance companies every single year. I call my insurance company because I've got properties, I've got my car and my truck. And if I can save $20, $30, $40, I know it adds up. And that's just a habit from when I was younger and I had no money and I had to do it. And even now when I have money and I have properties, I still do it. Okay. One step at a time. Focus on the first one, finish that, solve that, move to the next, and then just keep working on it. All right. And then the last thing is that I get this a lot, especially I think right now with where the market is and where the economy is, there's a lot of people who are kind of like the videos on my channel that are exploding right now are my school ones, my MBA one and what degrees to study and the happiest careers post-college. And I think a lot of that has to do with a lot of people who have lost their jobs and they don't know what to do in a depression or a recession. There's a lot of young folks not knowing what to do. And this is what I would encourage to everybody out there who is looking at investing, looking at learning, or looking at betting yourselves. There's two things that I think everybody absolutely needs. And I'm going to say this with knowing that I might get some flack, is that universally, I think every individual should have these two things. Ability to critically think and self-awareness. And I think without those two things, you cannot be successful in whatever it is that you want to be successful in. You might be able to be financially successful. You might be able to accomplish and get certain things done. But overall, I don't think that you'll be a good member to society or even to yourself if you can't think critically and you can't have a level of self-awareness where you know where your weaknesses are and you know where your strengths are. And I want to let you sit on that and think about it. It's just like what is your ability to think critically? Can you work through problems or even situations? Let's talk about we don't have to get too deep into it, but like this whole COVID-19 thing, or this whole racist movement that's going on, or this that President Trump's in office. A lot of that stirs emotions in a lot of people. And what I see in that is your ability to work through and think critically. When I say think critically, what that means is you're able to look at both sides. And just because I'm able to look at both sides, or that you're able to look at both sides, doesn't mean that you agree with both sides. And it's when you're able to understand both sides, you're able to make a better decision or communicate things in a better fashion. And a lot of times what happens is that folks, they get so emotional and they get so geared up and they are so attached and married to one idea is they forget to think about the other side. And what ends up happening is that you get butting of heads. And that same thing occurs in businesses. It occurs in investing. It occurs in real estate projects or whatever it is that you're trying to do. And so when I was hiring people, when I partner up with people, when I'm trying to do anything that includes other individuals, I always look for those two traits, is their ability to critically think and their level of self-awareness. Are they aware of who they are? Do they know who they are, for one? And also, are they able to understand their weaknesses and how do they mitigate that? And then how do they exploit their strengths? That's it. Off my soapbox, off my Tony Robbins kick. All right, last couple of questions, and then I got to get going. It stopped raining, so I'm going to get back to work. Of course, Mark, thanks again for jumping in. Mark, were you here the entire time? Cedric, were you here for the whole 2 hours? You guys were awesome. Are you not? That's awesome, man. You got paid out 2.5 months plus laptop, and you got a new job within 2 weeks at a 10% higher salary. That's awesome. What industry are you in? Yeah, the stocks is an extra boon for anybody, right? I mean, we've had it's been a 40% increase in stocks since the dip, since March. So insane. So insane. Software engineer, yeah. All my buddies, I have a bunch of buddies, my Dungeons and Dragons friends. They're all software engineers, programmers, and a lot of them were startups, fast growth startups that either lost traction or they lost their jobs, and just like you, they got rehired real fast by other companies for more pay. Oh, Mark, I thought you were a mortgage. I thought you were a mortgage broker. I thought you worked for a mortgage company. Registered nurse. Awesome. Hey, Mark, how is the COVID-19 treating you and your, I don't know if it's a clinic or a hospital that you work at. Have you noticed anything crazy? Is it going up or is it going down where you're at? That's awesome, Mark. If you want to become a financial analyst, you can totally do it. A lot of times you can, what I'm showing you right now is the baseline for a lot of financial analysts. Obviously, they go in a lot more depth and they dig into way deeper into the financials and the corporate earnings and everything. But this is basically, if you go to Harvard MBA school, this is what you'll learn. I'm obviously trying to make it as streamlined as possible because a lot of times when we're doing it and we're picking apart a company, we spend 15, 20 hours going through all the numbers and all the reports. But what we do here is really the kind of like scratching the surface of what you do. If you find it's super interesting, I find it really interesting. I like it. And you can make a lot of money doing it. Yeah, I know. I have a friend that's a doctor right now that they're getting, what was their, oh geez, she had to go to Chicago and she went there. She was going to make like, it was an insane amount of money. It was like $30,000 a month over that. More masks. I'm going, guess your follow-up. Yeah. So, Mark, you're Filipino? That's so funny. Jen was able to figure that out. I'm sorry you hate nursing. I know it's really tough. I had a lot of friends that went into nursing and think it's a lot more stressful than they originally expected it to be. Are you going back to school for financial advising? Or, becoming a financial analyst? It's something that you can do on the side too. Mark, it's never too late, man. You've got a good career right now. It's a hobby, yeah. Mark, I think you should start dabbling in it. I think that in the age of YouTube, I mean, like, if you guys don't know this, back in 2015, I learned how to build a house from YouTube, from just going online. I mean, obviously, I took a lot of other stuff where I had to read certain books, but like it was just between reading code books, watching YouTube videos, and then I built my first house from scratch. That includes running all the plumbing, running all the electrical, hooking up to the grid, everything. And I have a lot of friends who actually the best musicians and best programmers, they're self-taught. 45 with kids, yeah. Free code camp. I should pick up one of those and try to learn. I like your attitude. It's true, Mark. He's being true. He's being right. You got 15 plus more years. Bachelor's degree in economy. I think having an economy degree is phenomenal. I think it's great. I think that you should be able, but the one thing I would say is you should team it up with another degree that's more, I'd say economy is very macro. You should have a micro degree as well. So whether it's like business management, it's construction engineering, it's programming, it's having a very direct niche hard skill. And I'd argue that maybe business management is not a direct hard skill, but having that and teaming up with an economics degree is a great combo. But I would not say an economic degree by itself is super great, because you miss out on a lot of the other soft skills that you would learn, or I guess hard skills for some degrees that you would get from others. Because if you are trying to get a career or a job or even start your own business, if you just have an economics degree, you don't really have the skill sets to start up your own business. This is very broadly speaking, obviously. And you don't have the technical niche skills like programming or engineering or anything like that. So economy, I think, is a great degree. It's something that I wish I studied more. Yeah. Well, you guys, I'm going to let you guys go because the rain stopped. I'm going to go do some more construction. But thanks so much for jumping in. I think we, for a while, we had almost 30 people in the chat room. That's awesome. So keep on spreading the word. You guys are all so awesome. And I think I have so much fun. I think that's why I only want to spend an hour in here. I'm end up spending almost 2.5 hours. And I want you guys to be able to chat. But once I close out this stream, you guys aren't going to be able to chat anymore. But if you guys want to go over to the Discord and continue talking, please do. And I'll chime in whenever I can when I'm not chatting. I'm going to go over to my mom's there. We're going to make some Vietnamese food. We're going to make some bánh quanh. I don't know if you guys know what that is, but I'm going to eat that tonight. Oh, I'm so excited. But I need to go and wrap up this house because we've got 4 days, maybe 5 days of just straight rain, and I have no siding on 2 sides of my house, which is not fun. But Mark, I hope that you decide to pick up financial advising and that you're able to learn some cool traits. Jen A and Jen F, thanks so much for jumping in. Everybody, are you next? Ola Dokan, I'm sorry if I mispronounced your name, but Cedric, let's see, are you next? I already said that. Mark, you guys all are awesome. There's a couple of other folks. Steven, you guys are fantastic. Ray, Toro TV, I know you already bounced out of here. Ethan, Manuel, Josh, you guys are freaking awesome, okay? I'm going to get back to my regularly scheduled videos as soon as I wrap this up. I think I got another maybe 2 or 3 weeks of this construction project, but I'll keep doing these live streams. I hope I'll see you here next Sunday. Other than that, I love you all. Thank you, and enjoy the rest of your weekend. See you guys.